Hello, this is Dean Malone with CompassFX. I hope you're doing well today and you get some good trades. In today's video, I want to cover where to place stop loss orders. I'm often asked by traders, where is the best place to put a stop loss order? Some traders will put it in too tight and they get stopped out. Sometimes we put them too far away and we look at a pretty sizable loss if that happens, unless you change your position size. So my thinking is, let's go through some of the places that are better locations on a chart to place a stop loss. First off, my suggestion is to place a stop loss above a resistance or below a support line. You can look in this chart and you can see that we have some highs up here, we have some lows down there. You're just going to put a stop loss if you're trading short just above the resistance or just below support if catching this move back to the upside. Now the question is, well, how far away from resistance or how far away support? Well, that's really kind of upon you. I like to at least give it at least the pip spread distance from the resistance area or from the support area. The last thing you want to do is put it right at support or right at resistance. You're just asking for it. The market's going to come up there, tag it, you get knocked down. So look to put it a bit above a resistance or a bit below support level. Also, take a look at placing a stop loss above a swing high or below a swing low. Now, this is really my favorite, and the reason for that is that a swing high or swing low acts as a temporary pullback for profit taking. So if you take a look at this, we can see that the market made a move to the upside. As it's making a move to the upside, it does this pullback right here and gives us this swing low right there. You see that? And then it pushes on back up. So a lot of times pullbacks, because of profit taking, will give you a swing low. We can see it here that the market pushes up to now a swing high and pulls back to a swing low. This pin right here. So what this represents to me is that the market is now pushed up to a higher level, at some higher level, whatever that might be, and then some profit taking is going to come in. Typically it's going to pull back so far. But what I like about this is typically as the market starts to make its move up from a swing low, the likelihood of taking out the previous swing low has a less amount of probability if the market continues going long. You can see it back here. See how it pulled back here? Right there, it pulled back and it pushed up. Didn't actually take out the high, but when it pulled back again, guess what? It didn't take out the previous swing low. So my favorite place to place a stop loss is just above a swing high if you're trading short, or just below a swing low when trading long. Now, as I say that, be aware of what the market's doing. If you're getting up there to where now the market's made an extreme move to the upside, is making its last attempt to the upside, and now it starts making its pullback, it may pull back further than the previous swing low. So you got to look at how far the market has moved. Let's take a look at another stop loss. Another stop loss is just beyond the next fib level. If you take a look at this chart, you can see that pretty much have a bullish flag pattern. See how the market's kind of gone up, has pulled back. Now they're getting a little extension here, but notice that the market's really holding the 38.2 level. Well, the best place to place a stop loss if you want to keep it fairly tight is below the 50 level. If the market just can't seem to get going, it might test at the next fib level and then take a bounce. So you want to be below this level right here in order for the market to say, hey, I can't go long, let's try to go short. If I go short and I run into buy limits right above the 50 level and I'm sitting right below it with my stop loss, it's a safe place to be, because the buy limits at the 50 level or right ahead of the 50 level may trigger new longs to push the market higher. So again, look to place a stop loss just beyond the next fib level. For those of y'all who have the dots method, use the buy stop loss, use the sell stop loss levels. The algorithm does a great job of calculating these levels. Now it depends sometimes if the market's too tight. So if the buy stop loss or the sell stop loss is fairly tight because the market's meandering, look at the next higher or lower dots level. In this case, we can see that the market gyrated a little bit around the open of the session that made a strong move all the way up almost to the buy target number 2. Then rolled over. Now notice this is a long, a buy indication here, and as the market comes down, it comes down to the sell stop loss level, but doesn't transverse the open of the session and come down to the buy stop loss level. So the buy stop loss level, a good place to put that. Now, with that being said, anytime you're into a profitable position, my suggestion is move your stop loss to break even or better. You may want to consider using a trailing stop loss. Now, last but not least is where do I place that emergency stop loss? I know some of you who may be listening to me don't normally use a stop loss, but prefer to use what some call, quote unquote, a mental stop loss. A mental stop loss, come on. We're thinking to ourselves, we're going to exit this trade when it goes too far against us. Well, you know what? When it goes too far against us, it's almost like, do I really want to take that loss? I mean, that's pretty big. I don't know if, it's going to take me days to recover from that. I just don't know. I tell you what, maybe by the roll of the dice or maybe enough wishing for the market to turn around, it'll turn around. It won't keep going against me. The appropriate thing to do is to have a stop loss. Whether you have one, as I suggested earlier, or you have an emergency stop loss. Now, one type of emergency stop loss that I know that a number of professional traders use is using the average daily range applied to the open of the day. Let's take a look at this chart. You can see that this is the dollar yen. It opens up at 122.58. This represents the open of the day. We have a 5-day average daily range. Frankly, it doesn't matter if it's a 5-day, 10-day, 20-day. You pick the average daily range you like to work with. The idea is simply this. You want to place an emergency stop if the market moves too far away. You're willing to allow the market to kind of gyrate up and down during the day. But if it goes too far against your position, you want out. So what we do is we take the average daily range and we add it to the open, and that's going to give us an emergency stop loss up on the high side. So if you were trading short and you were thinking the market may gyrate here, but eventually I want to go lower, I'm going to give it room to move around, then what you'll want to do is put your stop loss right above the average daily range distance. Now the average daily range isn't necessarily in one direction. It could be, in this case, we have 74 pips, so it could be potentially 44 pips up and 30 pips down below the open. But let's just say, for instance, that the market went strong in one direction, the full distance of your average daily range from the open, you could have an emergency stop sitting right up above that. And there have been times I've seen in the market that the market will move all the way to the average daily range and literally bounce right off of it and move back in towards the open of the day. Just on the flip side, what you'll want to do if you're trading long and you're looking for an emergency stop loss down below, then simply subtract the ADR from the open. In this case, 74 pips below 122.58. That puts us down around 121.84. Place your stop loss below that. Again, this is for an emergency stop loss, or for those of you who are kind of a swing trader, you're willing to allow the market to move around up and down until it decides on its direction. Now let's take a quick overview of what we've talked about here. First off, place a stop loss above a resistance or below a support. Place a stop loss a few pips above the last swing high for a short trade, or a few pips below the last swing low for a long trade. Place a stop loss just beyond the next Fibonacci level. So if you see if there's a Fibonacci retracement, the market's kind of sit at that retracement level, you're looking for a bounce off that retracement level back in the direction, then look at the next Fibonacci level and be just beyond that level. Another stop loss is in the dots method. For those of y'all who have the dots method, consider that the algorithm does all the work for you, gives you the buy stop loss, gives you the sell stop loss. More times than not, I've seen if the buy stop loss gets hit or the sell stop loss gets hit, either a couple of things are happening. Number one, the market really isn't wanting to go that way. It's turning and going the opposite direction. Or the market for that currency pair is just range bound, just chopping up and down. And if you're looking for an emergency stop loss, use the average daily range. Add it to the open for a stop loss up above price. Subtract the ADR from the open for a stop loss below price. And with that range, you're allowing the market to move around and decide which direction it's going to go. And one other thing I want to mention, stop placing stop loss orders at an obvious round number. You're just asking for the market to take your money. Okay? So avoid placing a stop loss at a 20 level, a 50, an 80, and a 100, especially the 50 and the 100. The market has a tendency to move to these levels. Also, you might want to consider 25 and 75. Those are definite levels that the market has a tendency to move to. So that is it in a nutshell. There's an appropriate place to place a stop loss, and then there are times where it's inappropriate to place a stop loss in a certain area. All in all, again, I've got to emphasize, if you're in a profitable position, move to break even or break even plus a few pips to lock in some profit, and then you have a free trade. You can take your mind off the trade and go look for another trade. Well, this is Dean Malone with CompassFX. I hope some of this information about where to place a stop loss order will help you in your trading. Y'all make it a great day. Get some good trades. I'll talk to you next time. Bye-bye.